Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. Lots to discuss this week. It is Thursday, February 19th, 2026. This will be slightly abbreviated given travel logistics, but let's get stuck in and share the slides. Well, I've called this podcast Inundated, as that certainly is the way it has felt all year. We have been inundated with news flow, with new ideas, with new phenomenon when it comes to AI. I've recently heard it said that there has been 50 years in progress in terms of AI in a space of about 5 months. So let's see how the next 5 months go on that basis. But equally, from a physical standpoint, we are also being inundated, whether it's in France with the snow, in the UK and other parts of Europe with rain. And it's been a lot to contend with. The picture is actually of a sunnier time from Munich. And the reason that's there is it's a relation to the recent, rather different tone set by Marco Rubio at the Munich Security Conference. What was said there in terms of it being maybe a spoonful of sugar, a slightly softer, sweeter tone with the European counterparts, and then a standing ovation ensued. So a slightly more cheerful response to Marco Rubio in this context, and that's why we're using Munich. As usual, we will cycle through inflation, interest rates, geopolitics, equity markets, and other asset classes. And in terms of the subtopics this week, we know that inflation is continuing to impress in terms of its ability to get in line, and we'll look at some statistics there. We will ask whether bonds hold the answer, given their complacency, or whether we should perhaps be looking elsewhere for the true picture of market movement. Going to look a little bit about AI and linearity and how some of the amount that we've been focusing on in terms of CapEx, how that perhaps is no longer a linear phenomenon that we should be thinking about, and how that is factoring in to the sentiment around AI. And back to geopolitics, as I mentioned at the beginning, it is continuing to rage in terms of the stress in geopolitics, but we'll ask whether it has failed the attention span test. Is it that markets have simply had too short an attention span, have moved on to the next topic of inundation, and are not properly taking into account what are perhaps some severe developments on the geopolitical front? As always, then, behavior when it comes to investor behavior and stock market behavior, we'll be having a look at that. So starting with inflation, there is a sense that it's starting to look convincing. There has been a sign that new cars have had their sharpest jump in 4 years, and that perhaps this has been masked by falling used car prices. This is perhaps a canary in the coal mine around tariffs. Even though it's been suggested that tariffs have essentially worked their way through markets with very little effect on inflation, new cars with the components, the metals, that is clearly an area that is going to show an increase at some point. The car makers are looking at their own troubles internally. They cannot necessarily absorb higher component costs for much longer. So that could be an example of a transmission effect that we're seeing in cars work their way through. So let's see, again, one to watch in terms of inflation. However, when it looks like the some of the other range, we're looking at the core PCE and core CPI, whereas CPI is now starting to come comfortably close to target, we can see that the PCE, that is one of the preferred measure of the Fed, has stalled, and that we just simply don't have the data when it comes to PCE. So even though inflation is heading in the right direction, we do not necessarily have the full picture yet. If we look at the breakdown that Bloomberg helpfully provides, we can see that there has been a diminution in the components of inflation that services represent, and that has been something that's very welcome. We can see from this chart on the left that services, as the red bar, has been the lion's share of inflation, as food and energy have come down, and even energy has been negative at times. But the fact that inflation has been now driven down by lower service inflation is perhaps, again, getting to this weakness in labor, that much of service prices were driven by a spike in labor. Again, it is important to remember this is not deflation, this is disinflation only. So we are still seeing inflation in the cost of services, which of course would accord with what the individuals on the ground are experiencing. Again, looking though at other, whether we trim the mean CPI, median CPI, super core CPI, or sticky price CPI, all of these measures are coming down. And what has been quite welcome news outside the US has been the sharp fall in UK inflation, which has fallen sharply to 3% in January there, which is increasing the odds of a rate reduction by the Bank of England in the month of March. This is a slide we showed last week, but hadn't had much chance to discuss. It is a discussion around fixed income and how the lack of volatility in fixed income is really the news story here. When we look at how fixed income has traditionally behaved in terms of its concern around credit worthiness or around market strength, and the way fixed income is currently behaving, there is quite a disconnect. And you can see that they have steadily calmed since Liberation Day. The question being is why bonds are so complacent, and has it been that much of the trouble in bonds and in fixed income has moved into the private credit sector? Equally, when we look at the expectations of rate cuts, it seems that we are now firmly behind the idea that we will be continuing to see rate cuts in the US. We at Moneta have predicted 3 rate cuts in 2026. Looking then at the spreads that we've seen in fixed income, suggestion here that spreads are at their lowest that they've been since the 2008 crisis. So a very low level, essentially going back 20 years. If we take that crisis out, what does this mean in terms of, again, the complacency and whether this is sustainable when it comes to spreads? Moving now to equity markets, there's been a lot of different, I say, noise factors that have been developed and discussed over the course of this week. If we look at the rotation, and we'll show some slides relating to that, rotation has been on everyone's lips. But there's also been some discussion this week around single stock volatility, that we've always noted that as this equity market has become more concentrated, that the potential for single stock volatility to become quite extreme has become enhanced. And we talked about this in connection with the Mag 7 and how stocks such as NVIDIA or other members of the Mag 7 had shown quite stark intraday volatility. And our corollary of that had been that if investors want to maintain the same exposure to equities, they will need to have to stomach a certain level, higher level of volatility day to day than they might have been used to in a more broad-based equity exposure. This chart I thought was quite interesting to show that single stock volatility in the S&P was now approaching heights that again had not been seen since the financial crisis and the 2000 dot-com bubble bursting. I will say, though, we are clearly not in a crisis mode. So the fact that we're tolerating and almost absorbing the single stock volatility, perhaps that says something about the investor behavior mindset that has learned some staying power, has learned to tolerate more volatility, perhaps through exposure therapy, because they have over time become more and more exposed to volatile tech stocks. Perhaps this doesn't necessarily act as an indicator of a financial crisis, but it is certainly interesting to see just how close it has come to the peaks the volatility showed during the financial crisis. Rotation, again, very much in the news this week. And what we've spoken about last week was these different levels where we are seeing rotation, whether it was from growth to value, from the Mag 7 into the other 493 stocks, out of certain sectors like tech into other more value-oriented sectors, and then out of the US and into areas such as Asia, Europe, and any non-US market. A further fourth rotation we can add here is a rotation out of the S&P 500 into treasuries. And this is something we're still, the relation between these two, we're continuing to see. And I would say that this is now being retraced back to levels that were shown in essentially higher than Liberation Day. This has been an interesting one to observe. Getting back to other sector rotations, this was an interesting chart from Bloomberg, which showed the fact that over 9 months, chip makers had beaten software groups by 120%. We can see that this has been very much in focus of the headlines this past few weeks. The SAS apocalypse, software as a service apocalypse, that has been generally heralded by the advancement of AI and the sense that these software companies perhaps could not be sustained. Their narrative is that they are embracing AI in terms of their functionality, but whether they could be replaced by AI, that has been behind the sell-off in these stocks over the course of this week. And what we can see, though, the chip makers are seen as an essential part of this AI trajectory, and the chip makers have been very solidly in demand. Looking again at how investors are receiving the news around AI expenditure, What has been very interesting has been in the past, say 6 to 9 months ago, when a company announced it was prepared to spend vast amounts on CapEx, this was celebrated by investors. Investors were very clear about the points they would give for certain behaviors that they wish to see in their underlying holdings. One was being savvy about AI, being, I think, on top of that, showing that they were likely to be leaders in that respect. And spending was at that time seen as a signal of their leadership. Similarly, when we saw cost cutting, that was again celebrated by investors. They were very much in favor of seeing margins expand and seeing that disciplined cost cutting occur by CEOs. And that was being celebrated. So when something is celebrated and rewarded, we see that then being copied across the board. Now the mood has changed somewhat around CapEx build out. And what we can see is that there has been a reticence to reward a CapEx build out and even a wariness as to whether that would all be sustained. The percentage on this is according to the Bank of America Global Fund Managers Survey, that the net percentage that say that companies are over investing with too much CapEx has gone from a negative now strongly into positive. And that has been a very dramatic change just in the past few months. Of course, we could say that this is groupthink, and that when we see the Global Fund Manager Survey, there is remarkable marching in sync around these points of view and very little contrarian thinking. But I think this is very notable that this is where the pendulum has now shifted. And let's break down just some of this expenditure. What we can see by the chart on the left is that the CapEx of these hyperscalers has soared. Free cash flow remains high, but let's watch that and put a pin in that for the moment. And debt issuance has continued to rise and rise somewhat sharply, certainly relative to 24 and 23, again, to fund much of this build out. In the past, we have seen that this debt issuance in the recent past has been actually quite celebrated by markets because they have been clamoring to get access to this debt. It is seen as a good credit and was seen as a good use of funds. But we can see, though, that there are still quite dramatic differences over the past few years in terms of that spending. When we look then at the cash flow, the trailing 4-quarter free cash flow, we can see the cash flow has been declining in these hyperscalers. That's quite evident in both charts on the left as on the right. And over the Q4, cash flow has been declining, which is suggesting that this CapEx is starting to erode the cash flow. Now, of course, the cash flow, this is what it could be used for, but the fact now that cash flow has started to fall in net terms suggests that this money for CapEx is being taken from somewhere else. And if it continues to fall, this will equally crimp the investment that is likely to be spent on other areas. So again, this is a trade-off, and investors need to decide what part of the trade-off they are comfortable with and what part they are likely to penalize. Focusing on trade-offs and some contrarian thinking, there has been a bit of focus in social media this week on Apple and how it has bucked the trend by not spending on CapEx on AI CapEx to the same degree. You can see that has actually had a dramatically smaller amount of CapEx spent over the last, say, 10 years compared to Amazon, Microsoft, Alphabet, and Meta, which have had sizable increases in terms of their CapEx spend. Apple has taken a strategy. It has not been seen as being a leader in AI, but equally with the ubiquitous use of iPhones and Apple technology, we do know that they are embracing AI in many of their devices with outsourced arrangements, and they have decided not to take a front row seat when it comes to CapEx. That, as you can see, has been quite a contrarian point of view, and that has been in focus and actually celebrated with interest by shareholders over the course of this week. Looking out into other asset classes, we have been looking occasionally at private equity to see whether any second shoe will drop in that case, given that there have been strains across some popular areas such as software. That has been traditionally a very popular one for private equity. We've also seen strains in private credit. A sector that was very much exposed to private credit was software, and private credit then being entangled in some of this sell-off that we're seeing. Equally, private credit has been a significant source of funds for data centers build-outs. We've seen that on the equity and the credit side. And as there have been some stalling or cancellations at some data centers, we've seen essentially these private credit groups walk away in those particular trades and declined to up their equity stake, say if there had been an equity holding in the case of a private equity player. So there is definitely a contagion effect that we're seeing across private equity. But let's look at the NAV and the dry powder that is still sitting out there on private equity partnerships and commitments that is there for spending. So we can see that this has only continued to rise, despite the fact that there has been a challenging fundraising environment. So as private equity continues to grow its funds on hand, we can imagine that there will be a lot of interest in M&A transactions. And we've seen that with Schroders and Nuveen just this past week, that there is a very ambitious desire to keep global consolidation, even in the maybe the less profitable or less high growth area of asset management. Moving to geopolitics, there is now in the headlines, just as we record this, quite a bit of saber rattling around the US and Iran. That has come in and out of the headlines as domestic politics has unfurled in the US, and the Epstein effect is starting to now see heads roll across both sides of the Atlantic. Some pretty meaningful in terms of the royal family in the UK. We've seen former Prince Andrew just be arrested today, and equally Bill Gates and other statements being made around his foundation, his involvement. So a very discernible ripple effect of the domestic crisis around Jeffrey Epstein. But equally looking now to geopolitics and Iran, we can see that again, oil is the bellwether for concerns around a US attack on Iran. And it is now touching $70 as the odds, and as expressed by Polymarket, of an attack in Iran have started to increase and get closer to 70%. So quite a significant increase from a low point that we saw in December, where those odds sat at between 10 and 20%. So clearly a buildup of tension in this region, and oil would be something that would be immediately sensitive to that. So I suppose it's worth doing some thought experiments at this stage to ask ourselves, well, what could be the fallout in markets were there to be an explosion of tensions in this region, and even any actual outbreak of kinetic warfare between the US and Iran. Clearly, the rhetoric on both sides has been stern and fairly forthright. So I suppose the question is whether any bluff is being played in this case, or whether there would be an appetite in Iran to take on the full wrath of the United States. That would probably be a worst case scenario when it comes to geopolitics. And given the existing strife within other areas of geopolitics, I suppose one bilateral breakout in tensions like this, it would be more unpredictable than it might have been before, when alliances and loyalties would have been more firmly cast. So quite a bit of uncertainty surrounding this geopolitics today. And as we look at the impact on equity markets, we know that markets are somewhat complacent themselves, but still worth keeping an eye on that. Moving to some other asset classes. So Europe has I mentioned Munich at the very beginning, continuing to be almost in focus in comparison to the US story of strength. Looking at the European Central Bank, we've just seen that Christine Lagarde will leave her position early. That could herald more uncertainty in terms of deciding who will inherit the mantle of running the ECB. But we also know that her move may have been strategic, and that she potentially wanted to allow the French government under President Macron to appoint the new head of the bank before any election, which could herald more uncertainty and more unpredictability around that. So I suppose a strategic move on her side, but given the confidence and I suppose the assurance that the ECB has been able to give over the course of the last few years, it has held steady when it comes to the maintaining the interest rates and ensuring an inflation rate has been lower in Europe. Any uncertainty around the ECB would not be good news for the outcome in Europe. We can see, though, that the common currency, the euro, is at its strongest in a decade. Some of that could be a knock-on effect of a weaker US dollar, but it also indicates a stabilization within Europe. And I would suggest green shoots that are available of some of the economies starting to turn a corner there, particularly an economy like Spain. So that is it for this week. It has been a somewhat short week as we look to having had a President's Day holiday in the US, and equally a quieter week on the European front as the kids are on school holidays and everybody's taken to the benefits of the inundation, where snow has been abundant in many of the ski resorts in Europe. So thank you very much for listening, and we look forward to seeing you next week.